Welcome to Corporate Finance. In problem 12.1, we are given a stock with an initial price of $74 per share. It just paid a dividend of $1.65 per share. Actually, it's D1, end of year. And their ending price is $83 a share, so you've made a nice price appreciation or capital gain on the stock. Compute the percentage total return. And the total return, two components of required return, are dividend yield plus capital gains yield. Since I have a common denominator of P0, I can take my change in market value, P1 minus P0 over P0 plus D1 over P0, or just put them both over the same P0 denominator. So what I really have then is $83 ending price, P1 minus P0 of $74 plus $1.65 of dividend over $74 P0, and I get a total return of 14.39%. What happens, let's break that up into the capital gains yield and the dividend yield. Dividend yield is D1 over P0, and capital gains yield is G, as we learned in Chapter 8, or also calculated by taking the price appreciation, P1 minus P0 over P0. So for the dividend yield, it's the annual dividend over today's stock price, P0, so $1.65 over 74. And the capital gains yield is P1 minus P0 over P0, or 83 minus 74 over 74, 12.16%. Total return is the summation of those two, dividend yield plus capital gains yield, 14.3919%, and that matches the number that we got in problem number 1. And in problem number 3, we see that the stock price at the end of the year has gone down to $61, so now we're not as happy an investor. Same formula. P1 minus P0, so 61 minus 74 over 74, plus $1.75 of dividend yield over 74. I get a total return this time of negative 15.34%, composed of the same dividend yield, D1 over P0, of 2.2297%, but this time the capital gains yield goes way down. It is 61 minus 74 over 74, and it's a big negative 17.5676%. And again, my solution is the same. This time I just broke it into the two components, but the total return is negative 15.3378%, so I'm not a very happy investor. Not as bad as if I just had capital gains yield, because this company does pay a nice dividend of 2.23%, but overall return, my return's not very good. There are your answers to problem 1, 2, 3. In problem 12.4, we're going to look at the total return on a bond, which is similar but a little bit different. So we're going to use that same formula that we used in the prior problems to calculate the total return. This time the dividend is kind of like the coupon, and the capital gain is still the price appreciation. So this 6% coupon bond we bought a year ago for $10.10. It's now selling for $10.25, so we're a pretty happy investor. In addition to this, we should get a 6% coupon on this, which is nice to get. $60 every year, $60-some every year. And inflation's eating away at this total nominal return at a rate of 3%. So they want to know, what is the total nominal rate of return over the past year? What is the total dollar return? And what is the total real return if we subtract that inflation? The equation is coupon received, this coupon rate times face, and capital gain is price, just like with stock, P1 minus P0. And the total return is that coupon received plus the capital gain and price. Percent total return will be my change in market value plus coupon paid over beginning market value. Again, same common denominator. And my Fisher effect will be 1 plus big R equals 1 plus little r times 1 plus h. So the coupon received is the coupon rate, 6%, times face value or par value of $1,000, $60. The total gain in price appreciation, capital gain, is $10.25 minus $10.10. And my total dollar will be that coupon plus the capital gain, and this total will be $75. So my nominal return will be $75 over the original bond price of $10.10, or 7.4257%. And the real return, I have to subtract that inflation amount, so approximately 7.4257 minus 3 would be 7.1257, or 4.1257, and we get 4.2968. So my approximate Fisher effect, just by subtracting the 3%, gets me close to that exact Fisher effect, which is 1 plus big R over 1 plus H. 4.2968% is your exact real rate, or exact Fisher effect. And problem number 5. We want to look at the average annual return on large company stocks from 1926 to 2019. So we can look at page 401 for the average. It's given to us as 12.1%, and that's the nominal. Again, the Fisher effect is 1 plus big R equals 1 plus little r times 1 plus h. So on this one, we'll solve for real. My total return is 12.1% right out of the table. My inflation over the past 90-some years has averaged 2.9%, and I just divide those two numbers plus 1, add 1 to each of those numbers and divide the numbers, and I get a real rate of return exact of 8.94%. If I had done the approximate Fisher, it would be 12.1 minus 2.9, or let's see, what is that, 9.2%. Yeah, 9.2%, very close to the 8.9%. So the approximate Fisher effect works very, very well. What's the historical real return on long-term government bonds? What is the historical real return on long-term corporate bonds? Again, same Fisher effect, 1 plus big R equals 1 plus little r times 1 plus h. I look on page 401 and I see that long-term, you can see that bonds in general give you about 6% on average over the 90-year history that's been studied by Ibbotson and Zinkfeld. So we get 6% exactly on average on long-term governments, 6.4% on long-term corporate. Inflation is still ripping away at that at about 3%. It's the more exact number is 2.9%. And so when I take the 1.060 divided by 1.029 Fisher effect, I get 3.0126% for the real rate of return. And then that's on long-term government bonds. On long-term corporate bonds, I do the same thing, except I substitute the 6.4% average annual total return, and I divide, in this case, 1.064 by 1.029, and I get a real rate of return on average of 3.4014%. And there are your answers to 4, 5, 6. In problem 12.7, we have two projects, X and Y, and with varying returns, calculate the averages, the variances, and the standard deviation. These statistical concepts are helpful to us because we know if we have a fairly normal distribution, plus or minus 1 standard deviation from the mean, 2/3 of all future returns will fall within that band. Plus or minus 2 standard deviations from the mean, 95% of all future returns will fall within that band, and plus or minus 3 standard deviations from the mean, plus or minus 3 standard deviations, 99% of all future returns will fall within the mean. So it's helpful to know how to calculate the mean, the variance, and the standard deviation, and that's what we're going to do in this problem. So you have investment X with 5 returns over the 5 years, some positive, some negative. Note that they're all stated in percentages. The first thing we want to do is convert them to decimals. So 0.13, 0.26, 0.07, minus 0.05, watch your signs, and 0.11. And if I add them up and divide by 5, I get an average of 10.4%. For Y, I do the same thing, add those 5 returns up, and I get an average of 12.2%. So you see that Y is a higher return stock investment. Now I want to see what is the variance and the standard deviation. So the next step is calculate the deviations. I take the actual minus the average. So each of these actuals, 0.13 minus 0.1040, 0.26 minus 0.1040, and so on down. When I sum up all these deviations, all 5 years, I should get 0 for both X and for Y. some of the deviations must be zero, or I need to go back upstairs and calculate the averages and then recalculate the deviations. And usually it's a case of sign. It's because you wrote down the wrong answer because of sign. So anyway, make sure that these deviations are adding up to zero. Step number 3 is I add everything, square them all up and add them up. So I square the deviations. So 0.026 squared, 0.156 squared, and so on to get rid of the negative deviations. I square them up and add them up. So I can add up 0.0007 plus 0.0243 plus 0.0012 plus 0.0237 plus 0, and I get 0.0499 for the deviation squared of x, and 0.2499 for the summation of the deviation squared for y. And then simply to get the variance, I take the sum of the square deviations, 0.0499, divided by t minus 1, small sample, observations. So I had 5 observations up above, so I'm going to divide by 4, and I get 0.01248 as the variance for x, and I get 0.06247 as the variance for y. From this, I take the square root in the final step to get the standard deviation, and I find x's standard deviation is 0.111714, 11.1714%, and the standard deviation is much higher for y, 24.994, almost 25%. So we see that stock Y is a more volatile stock. So for that higher average return, you're going to pay for it in more volatility, so be very careful. And these are the advantages to knowing how to calculate standard deviation and variance. You can see which of the two stocks are more volatile. And looking at number 8, we're going to again calculate standard deviations and variances. And we're also going to calculate that for large company stocks, T-bills, and the risk premium of those two instruments for the period 1970 through 1975. So if you know history, you know that this was a period of high volatility, high T-bill rates. So you can see them down below there, high T-bill rates, and wild volatility in the stock markets, as you can see from these large company returns. Even though large company stocks are generally not as volatile as small company stocks, they were wildly volatile in the period 70 through 75. You can see some big negative returns and some big positive returns. 71.14, 14% on your money. 72, 19% on your money. 73, wildly fluctuating down to 14.69% negative, and even worse in 74, 26.5% negative. And then a recoup in 75 recaptured some of those losses with a huge 37.23% return on large company stocks. So as we did in the last problems, we sum up the returns. We divide by 6 in this case because there are 6 years, and we get an average on large company stocks over that volatile period of 5.54%. We do the same process where we calculate the deviation from the mean. So we take the total return, 0.0386, minus 0.05538, and we get a deviation of minus 0.016. Again, watch your sign. Make sure you have the signs positive or negative when you subtract the actual return minus the average. So in this case, it's 0.1430 minus 0.005383, and I get a deviation of 0.0876. Again, check your deviations to make sure that they add up to 0. Mine do. So I can move on to the third step, square them up and add them up. I'm going to square up the deviations and add them up. So again, we're going to have large numbers of decimal places. So set your calculations to 8 decimal places if you want to get really exact answers. And I come up with a sum of deviations squared of 0.2698807. To get the variance, I take that number divided by t minus 1, or 5 observations. So I get a variance of 0.053977614. And then I get a very high standard deviation of 23.23% by taking the square root of that variance. Do the exact same process for T-bills. You can see the T-bill average was quite high over those 6 years of about 6%. I got that by taking the summation of the 6 years and divided it by 6 to get the average. So I take the 0.3548 summation of the T-bill returns, divide by 6, and I get an average of 5.9%, so quite high. And then I figure out the deviations, which are gotten by taking the actual return minus the average, so 0.0652 minus 0.00591333, and I get for the first year 0.00606667. Again, as you're doing these deviations, be very careful about your signs and make sure that all your deviations add up to 0. If you do, mine do, you can move on to the third step, square them up and add them up. So 0.00606667 squared equals 0.00003680, and so on down the line. Just square all those numbers in the deviation column and then add them up, and I get sum of the deviation squared of 0.00123879. To get the variance, I divide that again by 5, 6 minus 1. So 6 observations minus 1 in a small sample, and I get a variance of 0.00247759. And then when I square root that, I get a very tiny standard deviation of 1.5740%. Then we want to know the risk premium. That is simply the large company returns up above minus the T-bill rates, risk-free rates. So in the first year, my risk premium is minus 0.0266. In the second year, it's 0.0991. And I got that by just jumping up above and taking the large company return, 0.0386, minus the T-bill return of 0.0652, and I get a risk premium in 1970 of minus 0.0266, and down the line. I just subtract each of those numbers. Again, I want to go through the same process to calculate the variance in the standard deviation of the risk premium. So I will first of all calculate the average, which is divide all the 6 risk premiums up and divide by 6. And then same process to calculate the deviation. Take the actual minus 0.0266 minus the average minus 0.00375. And I get a deviation of minus 0.02285000. Similarly down the line for all the deviations, just take actual minus average, and I get 0. If I get 0 at the summation of the deviations, I can move on to the third step, square them up and add them up, square them up. So I take minus 0.0228500 squared, I get 0.00052212, add, square them all up, just like that, square all those deviations up, and I sum them up, and I get 0.297777158. Then to get the variance, I just divide that 0.297777158 divided by 5 observations, a small sample size, and I get 0.059554315 variance. Take the square root of that to get the standard deviation, and I get 24.4038%. Question, is it possible to have negative risk premium before an investment? No, it is not, because investors demand compensation for higher risk. Give me high risk, you better pay me high return, so there will be a risk premium after the fact. It is possible to have a negative risk premium after the fact if risk-free rate is very high in the case of high inflation, or if the nominal rate of return is very low, as was the case in 1974. Both happened. T-bill rate was very high at 8%, and the stock market was wildly fluctuating, where the nominal total return for large company stocks was negative 26.47. This can result in a negative risk premium after the fact. And there are your answers to problem 7 and 8.